sesh on why poor cash flow happens and why that could be an issue. So why poor cash flow happens? Well, 101, it's usually because of poor sales. Poor sales will mean lower revenue and therefore lower cash flow inflows. Number 2, over trading. So you might buy too much stock in the hope that you sell it, but you don't sell it. So you're sitting on a lot of stock and you've wasted all your cash buying that stock. So over trading, when you've spent too much on your stock, that might lead to less cash. It's very common with just-in-case methods there. You might want to switch to just-in-time methods in order to reduce that issue. 3 is poor creditor and debtor management. So debtor is those people that owe money to you, and creditors is the money you owe to other people, likely suppliers. And imagine a situation where the debtors on average are paying you in 60 days, but you are paying your suppliers in 20 days. Well, that might indicate a cash flow issue because you're paying everyone up, but no one's paying you anywhere near as quick. In fact, 3 times worse in that example. So it might be something you want to look at and renegotiate the terms with both your creditors and debtors so you get that number equal to each other, or even better is if your creditors is more than your debtors, because that would indicate that you are holding on to cash for longer. Number 4, no cash flow forecasting. So quite simply, you don't do a cash flow forecast, so you are just licking your finger and seeing which way the wind is blowing because you have absolutely no idea what's going to happen from month to month to month. So by doing a cash flow, you avoid poor cash flow, likely, because you can, as you've seen in the other video, you can manage and anticipate the things that will happen to you because you've worked it out, basically. So no cash flow forecasting is likely to lead to poor business management. And it's even more poignant if you have got a business that has seasonal fluctuations in your sales. Well, it's criminal if you don't do cash flow forecasting because you already know that maybe you sell pumpkins. Well, there's only one time of the year that pumpkins are going to sell. So you need to be aware of that and manage your cash flow accordingly. So why poor cash flow is an issue? Well, number 1 is that if you've got poor cash flow, then you've not got enough to pay your day-to-day expenses, your bills basically. And that's probably because you've got a lack of working capital. So if you remember that from the statement of financial position, sometimes called the balance sheet, that is when you've got an issue with your current assets minus your current liabilities. Likely that number is negative. That indicates you have a cash flow issue. Number 2 is if you've got poor cash flow, the worst case scenario is you cannot pay your workers' wages. You cannot pay the wages for your employees. That's likely to completely sap their motivation, and if you sap their motivation, their productivity is just going to fall off a cliff. They're not going to work for you. They might go on strike, and productivity in that case would be 0. So you want to be able to pay your employees. Number 3, if you've got poor cash flow, well, it indicates the need for sources of finance to rectify that situation. And if you're getting sources of finance, you're either going in external finance, the debt, or the equity route. If you go the debt route, well, now you're going to have to start paying interest. So that could make your cash flow problems even worse in the long term. Equity, well, if you're going to go the equity route, if you're a limited company and you issue shares, well, you're going to lose some control in that situation. And number 4 is, well, creditors, who are likely to be your key suppliers, well, they're going to be wary of giving credit to you in the future if you have poor cash flow. And if they've seen that on your financial statements, then they really are going to be very wary of you. Also, they might, as a result, they might reduce the time you have to pay. Maybe previously you had to pay in 60 days, now they're concerned about you, they want you to pay in 30 days. That's an issue for you, and that's going to compound your cash flow problems. It's going to make your cash flow issues worse. And also, you might just lose supplier goodwill. There could be a breakdown in that relationship as a result of this. So I hope that's helped you with these 2 questions. Good luck with your exams.